This is Linda Hitt. We're going to do a session on companies that sell a product. Merchandising companies need to deal with new account titles. So we will be learning a different type of a revenue title. Instead of service revenue, we'll have sales. Inventory or merchandise inventory is the title of the asset. So when you buy those goods, it goes into the asset account. When you sell them, it becomes cost of goods sold expense. Assets used up become expenses. And we'll look at other types of expenses when we do a physical inventory count. Often companies have to write down the inventory, and then we'll look at valuation. We'll be doing something a little different than historical costs with inventory. Contra accounts also will allow us to track information about returns from customers as well as discounts taken. Lots of detail in this area. Not every subject that we'll handle in accounting will have this much detail. But shipping charges, we may have to pay shipping to get the goods from the wholesaler. We may have to pay shipping to get them out to the customer. So freight in is the concept of paying the shipping from the wholesaler, and usually you don't have to do this unless you own the goods while they're being shipped, while they're in transit. So FOB shipping point or freight on board or free on board shipping point simply means that once the supplier ships the goods, the supplier no longer owns the goods, that it changes hands and we own the goods as the company. And we'll talk about how we account for that. If we ship the goods to the customer, then it's probably FOB destination or free on board, freight on board destination. That means that we ship the goods and we own the goods until they arrive at their destination, which happens to be the customer. We'll expense those goods at that point because of the matching principle. We have a sales revenue and we have a cost of freight. When we buy the goods from the supplier, we actually don't expense the freight because we haven't sold the goods. We have no revenue to match to. So in that case, we're going to add it to the asset. Discounts galore in this section. You might have a time discount, quantity discount, or just being nice discount. So we'll have some new things. The terms 110 net 30 or 215 net 60 all tell us that there's a time discount, that there's a percentage that's knocked off whoever buys the goods if they pay quickly. Quantity, as you know, if you order a lot of merchandise, some of you may have experienced that yourself, or special discount, maybe we offer something to a school or not-for-profit at a special price. Detail, detail, detail. We still have the general journal, the general ledger, and the trial balance, but we also have to track all those thousands of things that store stocks. So next time you walk into a retail store, appreciate all the work they have to do. Software does a lot of it for you, but still you have to enter data. So we'll have the inventory cost card for each different item. You'll see in a minute we have units, dollars, we keep it all. And if you have customers that owe you money, you're going to have to keep track of each individual customer, because if they walk into the store and say, "What do I owe you?" you need to be able to tell them what that is. We, of course, also have to keep track of our bills, so we'll have an accounts payable subsidiary. So let's now go to the problem that we're going to work on, and we have some basic journal entries to deal with. We're going to do the general journal entries. We're going to look at the impact, as we continue to do, on the statements, and then eventually we'll also, as we go through, work with these new records. The subsidiary cost card for the inventory. We also have accounts receivable, accounts payable to track the detail, and then I went ahead and put the general ledger here. We'll post to the general ledger to kind of do it all. The software would update all of it, and then in the next video clip I'll take the general ledger, we'll do a trial, and we'll do a multiple step income statement and a classified balance sheet. Okay, so first thing we're going to deal with is issuing stock for $20,000. I know you've done this many times probably at this point. So we know that cash is going to go up because we're receiving money, and common stock also goes up. If you think about the balance sheet, we have more resources, the cash. We have more stockholders' equity because of common stock, and of course that balances the balance sheet. At this point, no impact on your net income, and cash certainly is going up, and it's a way of financing the business. So we have F for financing. Then let's see if we can if we can look at this. I don't think anything needs to be done over here, but as we go through the journal entries, we're going to try to update the subsidiary and the general ledger. So I do need to update the general ledger. We have more cash. I'm going to debit cash, and I'm going to credit common stock. Whoops. No impact on the subsidiaries of the other subsidiaries. So let's go back to the journal. And like I say, I'll probably make some goofs here, but bear with me. So this one we borrowed money from the bank. We've done this earlier. And we know we have more cash. And if you sign a formal debt instrument, usually you have a notes payable. So borrowing money will again add to our resources. This time we have creditors, so we'll have liabilities. And eventually we'll pay interest on the loan, and it will affect net income because it would be an expense. And then finally we have cash flow. So cash does go up. And it's another way of financing the business. Okay, we'll go over here to the general ledger. See if I can keep this going. So we add to cash, and we add to notes payable. See if I can keep the debits and credits straight. Okay, now we're starting the merchandising transactions. So here we go. We've got 1,200 units of stuff. We do have credit terms, so we're encouraged to pay early. Within 10 days we get 2% off. We're going to use the gross method, so we are not actually going to take the discount right away. When we pay for it, we will then take the discount. So if we buy merchandise, we're increasing our inventory. And I'm going to, in the future, just cut and paste this. And when you see the terms given, that simply means that we are not paying. So it's the same thing as seeing on account. There's no mention of cash. And if we're smart, we'll pay it within 10 days. If not, then we have 30 days to pay it. So I'm going to put accounts payable. And then as far as amounts go, it's not hard math here, but let's go ahead and use the calculator anyway. 1,200 times 10. So we have $12,000 worth of merchandise. And we'll deal with the discount later. Okay, so we have more resources, and we do owe money. And we have no impact on stockholders' equity. No effect yet on net income because we haven't sold the product, and there is no cash flow. Okay, here I need to spend a little more time with the subsidiaries. So let's see if we can do this. Let me do the general ledger first. So it's 12,000, and accounts payable is credited 12. And then over here we have 1,200 units, and we have a unit cost of 10 and $12,000. And then the ending balance is 1,200. At this point, it's not so bad, is it? And 12,000. Subsidiary ledgers, yes. Let's go back and look what we have. We bought it from Super Supply Company, so we need to set up Super. That's going to be accounts payable. So let's put Super here. And it's a credit in the general journal. It's a credit in the subsidiary ledger. So you kind of track it the same way. So I owe Super $12,000. Whoops. Price type slowly enough, we'll be okay. Okay, so let's look back and see if we haven't. We've done the inventory cost card. We've done the accounts payable record. Okay, so I think we're good. Next, we return goods. Of course, occasionally it's send the wrong goods, they're damaged or whatever. This one we have damaged goods. So it makes sense that if you're returning merchandise, it's going to be just the opposite. but you're actually going to flip the entry. So I need to reduce what I owe, and I need to reduce the inventory since I'm sending it back. We would normally look at the subsidiary ledger, though right now it's not too difficult to figure out. We haven't had too many transactions, so $10 a unit is what we want to pick up for 200 units, and you can probably do that okay, but let's do it. 200 times 10 is 2,000. So we're going to reduce what we owe and have less inventory. So this should do just the opposite to your statements, and no impact on the rest of it. Okay, then I'm back to the subsidiary ledger. I need to adjust this. Now there's no return column here from the supplier. So what I'm going to do is adjust it where I purchased it. So I'm going to say minus 200 units. The cost doesn't change, and I'm going to have minus $2,000. And then over here, minus, over here is cumulative. So 1,200 minus 200 units is 1,000. Still at 10. So now I have $10,000 left. Okay, so we've updated that. And the subsidiary ledger, I need to also track that. So we're reducing accounts payable. So I'm debiting accounts payable, debiting the subsidiary ledger, and now I owe Super Supply Company only $10,000. I think that's all, hopefully. Okay, so let's go on to paying our bills. Now that we've done this, we're going to pay the bill to Super. Well, first of all, what do we owe Super? We just looked at that. So if we go back to the subsidiary ledger, we owe Super $10,000. But let me put the terms up here. The terms are what? 210 rather. If we look back, net 30. And it's probably helpful to have the terms at the top. So we are we reduce it to a zero balance, so we have $10,000, but we get a discount. So let's see what that discount would be. It's 10,000 times 2%. Make sure you put 0.02, or you'll take a big discount. So $200 off. So if we have 10,000 owed minus 200, we should be paying only $9,800. So this is going to require a compound entry because we have to reduce accounts payable by 10,000, or else if we use 9,800, we still show a balance of 200. So back to the journal entry, I'm going to debit accounts payable for the full $10,000. I'm going to skip a space and credit cash for $9,800. Okay, and we have the dilemma. So we obviously do have another account that we need to pick up. If you look at the amounts, we definitely need it on the credit side. And then we start to think about this. What else is impacted? Well, if you look at your first entry when you bought it, your inventory went up by the full figure at 100%. Accounts payable went up. So if you're paying them the discount, then historical costs would tell us that we should record the inventory at the price we actually paid. So since we actually paid $9,800, I need to reduce merchandise inventory by $200. So there's the compound entry, and you can see again it's a lot of work to go through that. If we look at the impact on the statements, inventory and cash are both assets. So our assets are going down in total by $10,000. We also are reducing liabilities by $10,000. And at this point, there's no impact on the income statement until we sell it. But we do have a cash impact. So the cash is going to go down by $9,800. And I won't show the amount over there, but this is part of our daily transactions. So certainly this would be operating. Okay, brace yourself. We're going to have to go in and do our stuff. And I'm sure I've already forgotten to do something. Yeah, in fact, I think on the the $2,000 return, did we do that to the, no, we didn't. In fact, I'm not sure we did the first entry. Yes, we did. Okay, so let me put in the return from the previous journal entry. We have a 2,000 and the 2,000. Okay, now let's tackle the payment. So accounts payable subsidiary, merchandise inventory subsidiary, and of course the general ledger. Maybe we should do the general ledger first. So we have accounts payable going down by 10, and you can see here it's going to come out to 0, and that's what you want. You only have one supplier you fully paid. Cash is going to go down by 9,800, and inventory gets a 2% discount, so we're going to lower that as well. Okay, then we're going to come back over here, hopefully, and figure this out. So we paid 9,800 for something that we had on the books for 10,000. So the cost, and there's no place to show a discount. So I'm going to go back to the purchases column, since this is still between me and the vendor or wholesaler, and I'm purchasing. And I'm going to reduce the cost of the goods by 200. Doesn't change the units, but it's got to change the unit cost. So if we go back to calculating this, I've got $200 less divided by 1,000 units. So that looks like 20 cents. Does that make sense? Okay. So minus 20 cents. So you can see this would be an absolute nightmare before we had software. If you bring the information forward, we've got the same units, so I'm going to repeat the units. It's cumulative, and then 10 units, or excuse me, $10 less the 20 cents should give me $9.80. So I'm going to put in the 980, and if you do 1,000 times 980, you'll get the 9,800. So now we've got the inventory cards done. And what else do we have to do? I've forgotten already. We need to do the accounts payable, right? So we're fully paid off super, full $10,000. The balance now becomes 0. And I think that might be it. Hopefully. Yeah, we've got the cash. Okay, let's assume it's it. If we don't, we'll figure it out later. Let me take those two off. Okay, again, not every subject's going to be this detailed, so it doesn't just get worse and worse and worse. We ship goods to the customer, so finally we've got a customer, we're making a sale, and we continue to use the gross method, which says I have no control over the customer. They may take the discount, they may not, so I'm going to put it in first at 100%. The sale is going to be an interesting situation. We're going to make two separate journal entries. First, we're going to deal with between me and the customer. The retail price, what am I charging the customer? If you see terms and it's shipped to the customer, we assume the customer did not give us cash right away. So again, it's like on account if you see terms. So if you remember, in the old days, we did cash and service revenue, or accounts receivable and service revenue. So now we're going to do accounts receivable, and instead of service revenue, it's going to be sales revenue. So there's accounts receivable, and you can shorten it to sales. I'm going to go ahead and put sales revenue since it's relatively new. The retail price was given, $20 selling price. So if we take 20 times 110, I've got 2,200. Hopefully that's right. But it's really hard not to make errors with so much detail. Well, I'm very good at making errors anyway. So what does the customer transaction do for you? More resources. Okay, sales revenue. We've got to balance the balance sheet here, so we're not finished with just one item. But sales revenue, if you remember, revenue is a retained earnings account. It's a temporary account. And retained earnings is part of stockholders' equity. So we're actually increasing stockholders' equity after closing is done. This is good news for your income statement. You got a profit, and we don't have the cash yet, so we'll hold off on that. But there's a lot of pluses going on. And with perpetual inventory, you also have to update the inventory. you've used up a resource. Assets used up become expenses. So here's where we're going to use the new account, cost of goods sold, and I'm going to add the word expense to it. And the asset we're using up is merchandise inventory. And then the question is, where do I get the information for this? It wasn't given in the transaction. So you actually go back to the good old subsidiary records, and you're shipping 110. So this is why this is so important, because there's all kinds of adjustments that can be made. $9.80 is the cost of our inventory. So if we come back over here and calculate this, we have 110 units at $9.80. That's 1,078, hopefully. Okay, so let's pick that up. And using up an asset, if you think about that, is simply fewer resources, cost of goods sold expense. Expenses are temporary accounts under retained earnings. So once again, we got to balance the balance sheet. In closing entries, expenses cause retained earnings to go down, which means stockholders' equity also goes down. And profits are going to be less, because we're going to subtract expenses, and there's no cash for this. So that's, again, a lot of work to get that done. Let's go to a subsidiary record and see what we've got there. I guess I can leave that there. Retail, let's do the general ledger first. So we have 2,200, I guess. Accounts receivable is going up, sales is going up, and then the cost of the goods were 1,078. So inventory is going down by 1,078. Cost of goods sold is being recognized somewhere. There it is, 1,078. Okay, so we've got the general ledger updated. The inventory, of course, has got to be updated because you just sold 110 units. So 110 units, and the sold here is sold to customers. The unit cost we can see in the record is $9.80, and we just did the calculation for this, so it's 1,078. Okay, then what's left? You had 1,000 units, you sold 110, so that's 890 units. The cost per unit still remains at $9.80, and then of course I've got to do the math again. So we have 890, and this again is a place, plenty of room for errors. Thank goodness for software. 8722. Okay, hopefully that's correct. Okay, so we've updated inventory cost card. Accounts receivable. So we have a customer, and the customer's name is Jim Smith. And we can put the terms, which should be the same for all the customers, I guess. 115 net 30. So Jim Smith. And actually, I still have 115 net 30 at the top, which is for all my customers. So we're going to debit. Accounts receivable is being debited, so we're going to debit that for $2,200. And Jim owes me $2,200. Okay, so we got accounts receivable, we've dealt with the inventory, we've done the general ledger, so I think we're good. Okay, next we have freight. We're paying freight for the goods shipped to Jim. Okay, Jim is the customer. It's FOB destination, so we actually own the goods until it arrives at Jim's place, which is the destination. So we have to pay the freight, which is what we're showing here. We've made the sale, so at this point in time it makes sense to record freight as an expense. So there's many names I could use. I'm just going to say freight expense. But transportation out is a term they sometimes use. Also delivery expense would be appropriate. Shipping expense. Paying for the freight, resources are fewer. Again, we have an expense. Retained earnings would go down. Therefore, stockholders' equity would go down. Less profit because of an expense, and less cash. A lot of negatives. And this is certainly day-to-day running the business, so clearly operations. I can go now to the general ledger, but I think we're good about not having to deal with subsidiaries, thankfully. So cash goes down by 70, and freight expense is right there. Try to set those all up. Okay, so far so good. Next, our customer unfortunately returns 10 units of product to us. It took 2 journal entries to sell the goods to Jim Smith. It's going to take 2 journal entries to bring the goods back, to cancel out part of what we did earlier. So if we look at the sale, here are the 2 transactions that we did, so we're going to reverse both of them, but for a much smaller amount. So I'm going to reduce sales. Now I could just do this. I could just debit sales and that would reduce the revenue. But if you want to track how much has been returned, there's a new account called Sales Returns and Allowances. And this is going to allow us to really see how we're doing with returns, because a retail company doesn't want to have many returns. So it's good for us to see how things are going. And of course we have to reduce accounts receivable. So if we go back, the selling price was $20. And of course we only have 10 units, so 10 times 20 hopefully is 200. Okay, so that's going to be our amount. And then we'll figure out the second part, which is to cancel, bring home into inventory. So we're going to increase merchandise inventory, and we're going to actually reduce cost of goods sold. Okay, this I need to go back and look. You may remember everything, but I don't. So most of the time we'd be looking at the record. $9.80 for 10 units. Okay, so again, we should be able to do that, but I'll do it here. 10 units times 9.8 is $98. Okay, so $98.98. And I think that's good. So the effect of returning merchandise should be just the opposite of the effect of selling it. I have less accounts receivable. I have less retained earnings. Sales returns and allowances has a similar effect to an expense. It's going to cause retained earnings to go down. And I have less profit because I have less revenue. Contra revenue is like a negative revenue. And no cash. And then the inventory, it's going back into inventory, so it's going to be an add. Cost of goods sold is being reduced. So if you reduce an expense, retained earnings actually goes up. And your profit goes up because you have less expense. Okay. So we've got to go back to the subsidiary ledger and do all of that. Let's do the general ledger first. So we have sales is going, no, not sales, but sales returns and allowances is going down by 200. Accounts receivable is also going down by 200. And cost of goods sold, we just figured out we need to reduce that by $98. And inventory is being increased by 98. Okay, so we got the general ledger done. Now let's see if we can figure out this. Returning merchandise from the customers returning the goods. So there isn't, again, any kind of return column. So under the sold to customer columns, I'm going to take away 10. Unit price doesn't really change. I guess I could go ahead and show it though. And over here then it means that there's less, $98 less from my sale. So here I've got to be careful. If I'm reducing what I sold, 2 negatives make a positive, so I'm actually increasing the number of units. So this should be 890 plus 10 units. We're bringing those units home. So it's 900 at $9.80. And once again, we can do the math for that, 9.8, which is 88.20. And hopefully that's okay. So we updated that. The customer owes me less money. So if I come over here and looking at the wrong one. Jim Smith is the one that owes me less money. So if we're not sure, I guess we'll go back and look. Jim Smith, the return was $200 on the retail. So we need to, it's a credit to accounts receivable in the journal entry, it's a credit here. So now Jim owes me $2,000 before considering the discount. Okay, are we good? Did we get everything? Who knows? Accounts receivable we tackled, inventory, subsidiary. So I think, keep your fingers crossed, we've got it. Okay, let's try another purchase. Okay, this time we're buying goods from a different supplier. So if you remember before when we purchase goods with terms, it's merchandise inventory and accounts payable. That's not going to change. We could do the calculations. This time we're buying 300 units of the same goods, but with the new supplier, they're charging us a different price. So here's $11 a piece. So it looks like $3,300. So we'll put that in. We kind of know the effects of this, so I'm going to, in the interest of time, not go back through this because you've already done this part. Let's go on to the subsidiary and the general ledger. So inventory is going up by $3,300. Accounts payable is going up by $3,300. Whoops. And if we look over here, let's add that. So we have 300 units being purchased at a new price, which is $11 a piece, which we know is $3,300. And when we come over here, we have sort of an interesting situation. We got units that we purchased at two different unit prices. So we're going to use the assumption called FIFO, which is first in, first out, which basically tells me keep those layers separate. Keep the older prices separate from the newer prices so that when we make the next sale, we'll be dipping into the older prices. So I'm going to leave the 900 at $9.80, and I'm going to put a separate level, the 300 at 11. And so really our ending inventory at this point would be adding those two together. Okay, so we've updated that. And then the accounts payable we need to update. If we go back and look, this is whole wholesaler, 210 at 30 are their terms. So whole wholesaler. Okay, and so 210 net 30, because it could be different terms. And it's a credit in the journal. So it's also going to be a credit in the accounts payable, in the accounts payable subsidiary. So we're going to have 3,300 credit and a balance brought forward of 3,300. Okay, so I think we did it all. Subsidiary, general ledger. Okay, let's go on to paying freight on charges from this wholesaler. Actually, this should have not been super. This should be whole wholesaler. The wrong person there, I think. Yeah. Okay. So for paying the freight, FOB shipping point means that 500 from wholesaler. As soon as the goods were shipped, we own them. So because we haven't sold the goods yet, we do, for matching purposes, we don't have any revenues. And this is part of the cost of getting the goods. We're actually going to add it to merchandise inventory. So freight paid from the wholesaler added to inventory. Freight paid to ship the goods to the customer, expense. And that's because freight paid to the, at the time of the customer's transaction, we already have a revenue for matching. So this may not feel right, but actually at this point you're delaying the expensing until you sell it. If you look at your account titles, we have one asset going up, one asset coming down. So we really have an asset exchange. And for cash flow purposes, that's going to reduce cash, and it certainly is part of operations. Okay, no impact on the income statement yet. So if we go over here, we've got the general ledger. We can bring that up to date for the freight. So $50 is added to inventory, and cash goes down by 50. Whoops. Here's cash. And inventory is involved, so you know what? We're back to the inventory cost guard. We cannot get away from that. And it's $50 more, so it's going to add to the cost of the purchase for $50. So what the heck do we do with that? Does not change the units. So if I think about it, it's $50 extra for 300 units. Unfortunately, it doesn't come out evenly. I should have done better numbers here, but I'm going to go ahead and round it. We'll have a little bit of a rounding error at the end, but we'll live with it. So 17 cents. We'll round it up to 17 just to make life a little easier. So it adds to the cost of the inventory. So now I've got, and I'm going to, let's just bring this here. 300 at $11.17, which is 3,300 plus 50. So let's go ahead and do that. Let me do this. I'm going to cut and paste this down one level. What I want to do is actually, I didn't like what I did. What I was trying to do is to keep the two levels separate, the two different types of inventory. So if I do that, then what I can do is repeat this. Took some of the color out, but that's okay. Okay, so you have 900 at $9.80. You got 300 at $11.17. So the ending inventory is still that. Okay. That's the worst complication. If you can live with that, we're good. Okay, so that I think takes care of the subsidiary record. So let's go back. Once again, we made a sale. 200 units, and we're going to again use the first in, first out. So we're going to sell the costs of the older units. We're going to use that first. So when we did this before, we had accounts receivable and sales between you and the customer. We continue to use the $20 selling price, so we have 200 units times 20, which is the 4,000. So I put 4,000 and 4,000. Okay, and then of course we also have to update the inventory. So we expense the cost of that inventory and reduce merchandise inventory. And how do we figure that out? We've got to go back to the subsidiary ledger. So it's 200 units sold. Here are our choices. 900 at the older price, 300 at the newer price. With first in, first out, we're going to use up the 900 at $9.80. And that's going to be tackled first. Then later we'll use up the others. So we're selling 200 units. So if I calculate that, I've got 200 units at the older price, which is $9.80. So that's 1,960. Okay, so we come back over here. We're going to do 1960. Looks like I forgot to put the rest of that entry in. 1960. And we have a lot of posting. Since we've done the sale before, I won't worry about the impact on the statements. But so we have, let's do the general ledger first. Accounts receivable, 4,000. And sales, 4,000. And then 1960, cost of goods sold, which is way down here. 1960, and inventory, 1960. Okay, now let's look at the cost cards. We need accounts receivable, and the name of the customer, if we go back and look. Looks like I forgot to name this person, but I use it later. So it's Alice Jones. Okay, so Alice Jones, we're going to set up a subsidiary ledger for her. and it's $4,000 debit to accounts receivable, so it's $4,000 in the subsidiary with an ending balance, of course, of 4. Okay, so that's good for the subsidiary. And then we have, of course, merchandise inventory for 1960. So it was a sale to the customers, so we should be able to pick up 200 units at $9.80 for 1960. And now we just have to be careful. We got we have 900 units at the older price. We sold 200 from that batch. So 900 minus 200 hopefully is 700. So we have 700 units at $9.80. And we can do that calculation. 700 times 9.8, which is 6860. Whoops, not there. 6860. And then bring down the newer units. We didn't touch those. They're still listed like they were before, which is 3350. Okay. Hopefully that looks okay. So again, your ending inventory is really is 1,000 units made up of 2 different distinct batches. Okay, inventory cost cards updated. Accounts receivable subsidiary was updated, and then I think we did do the general ledger. So hopefully, keep your fingers crossed. I think we did that part. Okay, now Jim, the other customer, pays half of what he owes past the discount period. Okay, if you remember Jim, and we shouldn't be looking at journal entries for Jim, we should be looking at the subsidiary. Jim owes us $2,000. And there's no discount, so he should be paying us $2,000. So let's do that. Okay, we're collecting, so $2,000 comes in, and accounts receivable should go down. So this is an asset exchange. It should just be fairly straightforward. One asset goes up, the other asset comes down. No change yet to the income statement for this, but we do have cash. Cash goes up. This is good news, so it's operations. Let me add that 0. Okay, then we have to go to the general ledger. For 2,000, we have more cash. We have less accounts receivable. And Jim has paid us, so paid us half. So up here, we need to record that for Jim. And actually, I need to change that. I said he's paying half, so it's really $1,000. My fault. I was looking at Alice, not Jim. So let's do 1,000 here. And let's go back to the subsidiary ledger and do 1,000. Accounts receivable goes down for 1,000. Cash goes up for 1,000. I'll get it right here in a minute. So Jim still owes me money. Accounts receivable is being credited for 1,000. So Jim still owes me $1,000. Okay. Hopefully we're good on that. All right, let's see what else we've got here. Alice pays, but she pays within the discount period. So this is going to be a little more challenging. A lot more challenging. Here's Alice for 4,000. Our terms are 115 net 30. So if we look at her calculations for that, $4,000 times 1%. She gets a 1% discount. So the discount is $40. And then if I take 4,000 minus 40, she should be paying me $39.60. Okay, so keep that in mind. $39.60 and 40. But if you look at the accounts receivables got to go down by the 4,000. Otherwise, it's going to show a balance. So cash is going to go up by $39.60. Accounts receivable is going to go down by 4,000. So we know that it's a compound entry. We've got to have more than 2 accounts. So let's put the 2 accounts in that we know. Cash comes in. It's a $39.60. I'm going to skip a space and allow for something else, and then accounts receivable is going down by the full amount because it went in at the full amount. So we can see that we need a $40 debit to get this thing to balance, and we definitely want it to balance. So the question is, what do you debit for this? Well, we offered the time discount. We're going to get less money, so that's actually not particularly a good thing. So this is actually going to reduce our revenue, but we're so willing to do this because we really need the cash flow. Cash is very important to us. If we don't get the money from this, maybe we have to borrow money. So we could just debit sales revenue, or if you want to evaluate how you're doing and if customers are really taking the discount, then you can use that new contra account, which is a negative revenue, but it tracks all the discounts taken. And in the next video clip, you'll see how it shows up on the income statement. Okay, we balance. We got a lot of stuff going on there. So let's see if we can put it together. We have more resources. Cash is going to go up, as we can see. But we also have less resources. Accounts receivable is going down. They're both assets. Accounts receivable is going down by a larger amount than the cash. So we're actually $40 less in assets because of this transaction. I'm going to go ahead and put the 40 just to kind of emphasize that. So that's the discount. And sales discount reduces profits, reduces retained earnings. Again, it operates like an expense. So when you close to retained earnings, stockholders' equity is going to go down by 40. And then, of course, we get cash. Oh, excuse me, we have net income to deal with too. Less revenue means less profit. And then for cash flow purposes, you can see the amount, so I won't put it there, but we have cash coming in, $39.60, and of course is very much as operations, the day-to-day. So that's probably one of your more complicated entries. Now let's see if we can transfer it over to the general ledger and the subsidiary ledgers. So it's $39.60. Sales discount is down here. Again, that's the opposite balance of a revenue, a contra revenue would. And we have cash, sales discount, and accounts receivable. Accounts receivable is going down by the full $4,000. Okay, so I think we got the general ledger down. Now we need to deal with the subsidiary ledgers. Accounts receivable for Alice, we're crediting accounts receivable for $4,000. So now she's down to 0. Fully paid. And I guess that's probably it. Okay. So we have just a few more entries and then we will stop with this clip. We bought store equipment. Put this in here so that later when we do the statements we have something to put on the balance sheet. So here's the store equipment being purchased. It's really an asset exchange. One asset goes up, the other asset comes down. It does not impact income statement until we start to expense it and use it up. And then for cash flow, we have less cash. And this one is investing. Purchasing assets or selling most assets would be here with the cash flow. Now we've got two entries at the end of the period. Many stores will sometimes close and take a physical count, and what they're doing is they're checking the records against what's actually in the store. So the physical count reveals 995 units. Okay, so let's go back. We have to track units, so we would have a record someplace for that. But we don't, so let's see if we can just do some calculations here. So how many units do we actually have? And actually, why am I doing this? What am I forgetting? The good old subsidiary records. So there's really a purpose for this horrendous document. Okay, if we look at the ending balance, we got 1,000 units of inventory. We just counted and we have only 995, so 5 units have disappeared. Let me just show you the math so we make sure that we're clear. It's the 700 plus 300 from the subsidiary, and you go back and you can see that from the journal descriptions. If I then subtract 995 units that we counted, we're short 5 units. Okay, probably that's not too bad. We could have made errors in record keeping. possibly there was a small theft of some kind or breakage or whatever. So whatever it is, we've got to get rid of 5 units. Because we're using FIFO, I guess we'll go ahead and take it off of the older units. So there's no place, of course, to show this. So I guess what we'll do is we'll just take it off of the purchase side since we didn't necessarily sell. I guess it really doesn't matter. So I'm going to say minus 5, and I'll go ahead and use the 980, and then we'll do the calculation. So what's the cost of 5 units at the older price? $49. Okay, so minus 49, and then I'm going to bring it up to date. So we have, again, 700 units of the older minus 5. I'll have 695 units left. Okay, so I'm just bringing down the older stuff. 695 at $9.80, and we're going to do the math again to get that. 695 times 9.8, 68.11. Hopefully my math is okay. And then I'm going to repeat the newer layer, which is 300 at 17 rather, for $33.50. Okay, so this is the new stuff. Now we've got, you can see, 695 plus 300 units, 995, which is what we said we have. I don't usually do it here first, but I'm just going to leave it. Now we're going to address $49 less. So let's go back to the journal entry, which usually we write first. $49, I'll put it in here. And because we no longer have the resource, assets used up become expenses, so whatever happened to it, we don't know. We're going to use a new account called loss on count of inventory, or just loss would be fine. That's an expense account, and we're going to credit merchandise inventory. So we have fewer resources, assets are down, loss is an expense, which will close to retain earnings and bring stockholders' equity down. We'll have less profit, and it doesn't impact cash. Okay, so when you think about the next time you see the store closing, can you imagine counting all that stuff? And then this is the consequence. We're doing basically an adjusting entry for the books. Okay, then we have something else that's new and different for inventory. We're not using historical cost. We have to check with our vendors or suppliers and find out what the replacement cost is. If we were to buy the inventory on December 31st, if we're on a calendar year, what will we actually pay for it? Now, if the price always goes up, if you have inflation, there is no entry. You then would have to use historical costs. But what if your price dropped? You know, occasionally things do change. Well, here we call the merchandise the wholesaler, vendor, and we find out it's gone down to $9 per unit. If you go back and look at your records, you paid $9.80 and $11.17. Obviously, I picked a big drop because I wanted to kind of show that. So, whoa. What should we record the inventory for? Well, we've got 995 units times $9 a piece, right? So the supplier told us 9. So when we finish everything, I'm going to put this in here just so I remember, $89.55 should be our answer. And now that we have a lower replacement cost, then this is what I should be showing as the end result, which really changes things up. The replacement cost would then take over. Again, usually you do the journal first, but just to show you, we're going to have to do that. And probably what I should do, and I did this again, let me bring it down a line. We're going to have to adjust both these records, actually bring it down 2 lines. So I'm going to just show you, it's not anything too awful, I guess. The units are correct. Yeah, let's do this first, and then we'll go back and we'll put the journals in. So the units are good, 695. I'm going to do the 2 different batches. And then we know it's 80 cents less, right? So minus 0.80 80, because we need to show that change. So 695 times 0.8, 556. Okay, so I'm dropping the cost of 1. And the thinking here is write down the inventory, take the loss, get it over with as soon as you can. We call this a conservatism principle because basically if the wholesale price drops, probably the retail will as well. And then what happens to the other? Well, let me put this here. Let's do the math first. We have $11.17 less $9. So that's writing it down $2.17. That's going to be slightly off, unfortunately, because I rounded it. I think it's probably $1 off. So if you take 300 units times 217, I get 651 minus 651. Okay, so we're adjusting both of those, and it may be, I think it's $1 off, but we're just going to go ahead and leave it. The end result should be 995 times $9. Okay, so 89.55. So I need to reduce my inventory by what? Let's put that in there. We'll do one calculation for that. We have 68.11. Okay, all I'm doing is picking up the ending balances before this adjustment. 68.11 plus 3,350 is we had 10,161 in inventory. Then I'm going to subtract the 89.55, which is what we're going to have, and so $1,206 is what I want for the journal entry. So let's go back. So this is really a lot of detail. But once we get past inventory, we won't have this much, thank goodness. And it's very similar to the physical count. I'm going to call it LCM expense, which is lower of cost or market expense. Lower of cost or market is the new value. It's not new, but it's a valuation for inventory that's different than historical costs. Most of the assets we know are historical costs. This is one of those exceptions. And of course, the merchandise inventory also gets written down. So let's see what we did with the journal. Did we do the $49? I may have. Yeah. We did the $49 inventory loss from the previous entry, and now we're doing lower of cost or market, 1206 and 1206. Okay. Hopefully I've got all the stuff in there, but I will make sure for the next video clip if we forgot to record something. And we did the subsidiary record. So this is now physical count we have, as well as the replacement cost. So this is completely updated for everything that could possibly happen to us. Okay, and we're almost there. I did one more entry, again, just sort of give us something to do with the next statement that's a little more complete. If you accrue interest, it's an accrued expense. This is an adjusting entry. An accrued expense means to pick up a cost that we've incurred that has not been recorded in the daily entries. So we often saw it with salaries. Somebody works for us. But here, usually you calculate, and we'll learn this later, we determine what the cost of the borrowing is for this period, which usually is principal times interest rate, which is annual interest, times time. So many months over 12, days over 360. So we'll deal with that later. So what is the effect on the balance sheet? We have more liabilities. Expenses are retained earnings account, so that's going to cause stockholders' equity to go down. We have less profit because of the expense, and then there's no cash. Once you get to adjustments, we don't have to deal with cash. Let me update the general ledger for that, and hopefully we might actually have everything done. Oops, guess what I forgot to do? I didn't record the purchase of store equipment in the general ledger, so We'll throw that in. And like I say, I'll make sure the next clip we've definitely picked up everything in the general ledger, because we will deal with trial balance and the income statement balance sheet. And then there's interest payable. So, yes. And so the final thing, we would total up everything, of course, to get one balance per account. That's what's the purpose of a general ledger. And your total for accounts receivable in the general ledger should agree with adding up all the different customers that owe us money in the subsidiary ledger. And then the same thing's true for accounts payable. The one balance in the accounts payable should agree with the subsidiary ledger's balances added up. But we'll deal with this in the next clip. So that